Thanks, Chuck. So Brad and I are, we basically broke this up into two pieces. We are going to touch on individual first to some degree, and then on the business, which he'll be doing the business. And the reason we do that is because most small businesses are flow-through entities, so any business transactions that affect your business is going to affect you individually more likely than unless you're a C corporation. So we're going to touch on some things that are for individual, and then he's going to go over some of the business items that have changed. So some of the changes for individuals, obviously, are that I'm going to go over are the tax rates, the standard deduction, eliminations and suspensions. There's a lot of things that have been eliminated and suspended. The child and family tax credit has changed. And obviously everybody's heard about the state and local income tax, what's called SALT, which would be state local taxes, including real estate taxes. And then some changes to the mortgage interest deduction, and also with medical expenses. And there's some big changes in estate and gift tax with the exemption amounts. And obviously alternative minimum tax has changed substantially as well because of the changes to the itemized deductions. And the last thing, kiddie tax has changed substantially too. So I'm going to cover some of those things as well. So first, then obviously is the rates. A lot of the rates went down, like the first rate stayed the same, but many then go down 2 to 3% as it goes up the scale. The 39.6 now dropped for married filing jointly to 37 is the highest. So pretty much across the board, there's lower rates, which will save everybody some taxes. I've put in here as well the single rates, in case anybody's out there that's single. And we've run there's married filing separately, and we've run some analysis at work, and we've done it for various levels of income, 100,000 up to $1 million. And pretty much we haven't really found a scenario where the person was not getting some tax cuts. The other thing that we have that's really big on the individual front is the standard deduction change. Basically, like for a married filing jointly, it's $24,000 now. And because of, I'll mention later as well, with the change with that SALT where the state and local income tax is limited to $10,000, you basically will need mortgage interest and real estate taxes as a married person of at least $14,000 to be able to itemize. So this is going to eliminate a significant amount of individuals from being able to itemize. And there's some concern, at least with nonprofits, that the fact that a lot of people will be eliminated from being able to make charitable contributions deductible, that their revenue is going to drop significantly. And so they have been worried about it. So some of the things that are eliminated with this, beginning in 2018, personal exemptions are now gone. And partly the standard deduction going to $24,000 for married filing jointly was to help make up for those personal exemptions. The other thing too is the moving expenses are suspended except for very limited situations such as military personnel. If you're ordered to be transferred, then you have to, then you would still be able to get the moving expense deduction. And then alimony as well is suspended for divorces after December 31st, 2017. And we noticed at our firm over the last 3 or 4 years, without exception, most of our clients that were paying alimony were getting audited by the IRS where they were requesting proof of alimony, actual agreements. So I think them eliminating this is going to eliminate a lot of disparity between ex-spouses of one reporting too much alimony expense and the other one reporting low alimony income. The other large thing too is the healthcare mandate under the Affordable Care Act. is permanently repealed beginning after December 31st, 2018. So after this year, then there will no longer be any penalties for not having health insurance, which there's a lot of statistics on it now that the uninsured will now go through the roof because there's no penalty. And I personally know of clients that were younger, that were successful, that owned businesses that still wouldn't get it because they felt that they would not, that they were healthy and they wouldn't need health insurance. But once the penalty went into play and they had to pay thousands of dollars, then they went ahead and got health insurance. The other thing is the casualty and theft losses. Under the old law, the losses were deductible to the extent that they exceeded $100 or 10% of adjusted gross income. Now they will not come into play at all unless it's a presidential declaration. So if somebody steals your car and you have no insurance, there will be no deduction anymore. If your house burns down, you don't have or have homeowners insurance, it'll no longer be deductible. And another large elimination is the retirement recharacterization. And I personally, with clients, have done planning when some folks will retire at like 60 years old and they'll have no income, but they'll be using their savings basically to live on until they reach Social Security or when their pensions start coming into play. And what we would do is we would do Roth conversions, sometimes to use up their 15% bracket, some people to a 25% bracket. And if the market would suddenly collapse like it had done in the past, we were able to do recharacterizations. So if I had somebody do a Roth conversion who had a business loss, let's say they had an NOL in 1 year and it was $100,000, so they had, not only did they not have taxable income, but they had a loss of $100,000, I could perhaps do a $150,000 Roth conversion and they would pay no federal income taxes at all. And as everybody may know, IRA distributions are taxable, but Roth distributions are not. So, but what would happen is if we would do a Roth conversion of 150,000 and then the market would, would fall 20 or 30%, we were able to recharacterize it and put it back into an IRA and then reconvert. And now we're not going to be able to do that. So like I'm working with a client that's retiring from PPG, and he's younger, and he was talking about doing his Roth conversion now, and I warned him that if his income would change this year or if the market would go down, he would be stuck with that recharacterization. So, and I also work with a lot of clients, older clients that are retired, that are married, and we're able to do $5,000 or $10,000 Roth conversions every year to use up their 15% bracket. So the other large change is the child and family tax credit. So it used to be, it was $1,000 per child, and there was very low phase out. So a lot of higher income taxpayers were not able to take advantage of the credit. And what that represents is children that are, this part didn't change, children that are under age 17 at the end of the year, and the child has to be your son or daughter, and your child did not provide more than half of their own support, and you must be able to claim them as a dependent, and they have to be a U.S. citizen. So now, as a married person making up to $400,000 before the phase-out would kick in, you're going to be able to get a $2,000 per qualifying child tax credit, whereas in the past, you were unable to get anything. And I think that was put in part because getting rid of the exemptions obviously got rid of a deduction. Now, normally, if you're a higher income taxpayer making more than $400,000, you, as a married couple, you weren't getting exemptions anyway because they would phase out, and you weren't getting exemptions if you did get them because you were paying alternative minimum tax. So, but then to do that for higher income people, then what they did is, obviously it's available for everybody, but they did cap the refundable portion at $1,400. So the person that's a very low income, making $7,000, $8,000 a year, they're not going to be able to get a $2,000 per child tax credit refund. Some of the changes to the itemized deductions, which I've already touched on, is the SALT, the state and local income tax itemized deductions. So basically now, beginning in 2018, your total real estate taxes plus your state and local taxes paid is deductible only up to $10,000. In addition, the mortgage interest and the mortgage interest on loans used to acquire your principal residence and the second home is deductible only up to $750,000. So and one of the other things that came into play as well with that is that home equity loan interest will not be deductible any longer. So people that would go out and use their home equity line of credit to buy a car the interest isn't going to be deductible anymore. Now, although car loan rates have been pretty low in the last 6 or 7 years, I don't really know that many people that have been using their home equity to do it, but that's no longer available. Also, under the new law for 2017 and 18, they did reduce the medical expense deduction from 10% back to 7.5%. That's one of the things that they did change for 2017. It was at 10, they made it 7.5, and for 18, it's also at 7.5. And I'm going to talk real quick on some planning that occurs with individuals if you have an elderly parent. What happens from a tax planning perspective is if I have a client whose mom is single, she's going into a nursing home, and now she's paying $7,000 or $8,000 a month, this once again gets into the play of considering Roth conversions, because what will happen is mom may have a lot of savings, it's sitting in CDs, which doesn't earn a lot of interest income, so her income's very low, but now she has $100,000 a year in nursing home expense, which is a medical deduction. So what we will do with clients that are in that situation is we will have the mother begin to do Roth conversions so that we use up their low tax brackets and so that medical deduction doesn't get wasted. So what you do is, it's all planning would be, you basically have to, in tax planning, if you were doing it yourself, you would prepare mom's return as a mock return, like if you were using TurboTax, you'd put that in and then you would see what her taxable income ends up being. So if it's a negative $80,000 because of her health care expenses, then you just start putting amounts in for an IRA, and you could perhaps convert Roths or convert IRAs that when you inherit them and they're subject to income tax, you could convert them to Roths without having any federal income tax, and then when you inherit them, there's no income tax to you. And typically children are in higher brackets than what their parents are. So there's still going to be a lot of individual planning occurring even if mom never itemized her deductions, but now she finds herself in a nursing home. And the other big individual item, and obviously this is important for businesses as well, is the estate and gift tax exemption doubled for everybody. So now a single person is $11.2 million, and a married couple is $12.4 million. So basically, what this means is that you can now, and because it's called the unified credit, it's unified with gifting as well. A person now could gift up to $22.4 million, a married couple, without having any gift tax liability to reduce their estate, and therefore be able to freeze their estate. So what wealthier people will do is if I've had a lot of clients at the $12 million range as married couples. $22.4 million is a pretty big number. But what we would do is to freeze an estate, like when the exemption amount went up to $5 million a few years ago, to freeze your estate, if you have $10 million in your bank account and you don't give it away and you continue to live, In 3 years, it'll be worth $13 million. So the only way to freeze your estate is to gift it to the next generation. And the other thing that's in this as well is what's called the generation skipping transfer, which at a high level, the IRS did not want people to skip over the next generation by gifting their money to grandchildren rather than the children, because the idea behind it was, what I have, I leave to my children, and then after the government takes a cut, and then when they die, it takes a cut again going to their children. So, but now with 22.4 million, if you have children or children that are doing extremely well, you may just now want to skip it and have it go straight to your grandchildren. And a lot of clients are doing this through trusts. And so it's basically called a generation skipping trust. And a trust would be set up where you can have those assets stay in there either for education, typically for health education, maintenance, or support, and you could have your children as the trustees. So you would be able to, even though your grandchildren might be very young, you still would be able to control the money so that they wouldn't necessarily waste it. And by doing that, you wouldn't be putting more money onto your own children to increase their estate so that it gets taxed again. And it works with PA inheritance tax hasn't changed, so skipping the generation saves the 4.5% for Pennsylvania inheritance tax as well. And we have business clients too that have even put their S corporations in trust for the next generation as well. So there's some interplay with businesses as well. And I have a lot of clients that want to try to control their children or their grandchildren from the grave. And a lot of times it's important because you don't know if your child's going to get a divorce or if your grandchild's going to get a divorce, and what you give them, you're basically half of it's going to go to their spouse. The other big change too is the alternative minimum tax. And basically now, from a high level again, alternative minimum tax was basically put into play to create a situation where you would always have a minimum tax that rich people would pay. And obviously, a lot of middle class people ended up paying it because once you would get to about $200,000 of income, and if you had enough dependents, which were our AMT preferences, you would be into this tax. So basically, what this tax would do is, for AMT purposes, when CPAs or you're preparing your own tax return, you prepare your tax return under regular tax method, and you basically are preparing a second tax return using alternative minimum tax calculations. And what AMT on the big things wouldn't allow is it doesn't allow exemptions for personal exemptions. It doesn't allow state and local income tax, and it doesn't allow miscellaneous itemized deductions. Well, with the new tax code, they eliminated exemptions, so now they're no longer an AMT preference because nobody gets them. They reduced tax deductions for state and local income tax to $10,000, and they've eliminated many of the miscellaneous itemized deductions. So now the three biggest AMT causes are now gone. So I think they're talking that for 2018, well, for 2017, they're expecting 5.25 million tax returns are going to be in AMT. For 2018, they're expecting only 200,000 filers. So it's cut it down substantially. So to talk about this more is probably pointless because you're likely not going to be into AMT anymore, but you should know that if you were in it, you probably will not be in it anymore. And it doesn't mean that you're necessarily ahead, because you are losing deductions as a result. Okay, so then the other thing that changed that could affect you is the kiddie tax. So under the old laws, the kiddie tax, what the federal government was trying to prevent was the transfer of wealth from parents to children while they were still underage to use up their low standard deduction and to use up their low income tax rates. So under the old law, what would happen is if the child would have more than $2,100 of investment income, that excess would be taxed at the parent's rate. So they thought, well, if we force it to be taxed at the parent's rate, it'll discourage the transfer of money, of investable assets to kids because of the high tax rate of the parent. But now what this does, it makes it even more brutal, is it now tees off of the estates and trusts tax rate. And as you can see, over $12,500 of investment income for your child that's a minor, you're going to be paying 37% income tax on it. So it puts even a larger bite into trying to transfer any investable assets to children. And maybe a lot of you didn't know about the estates and trust rates, but they're in there basically so that if you ever hear like rich people are accumulating a lot of income within trusts, it's baloney, because I do trust returns for clients and they're over, $12,000 or $13,000, they're paying 39.6%. So the law was put into place to force trusts to distribute income to the beneficiaries, because leaving it in there was brutal. So the only one that would want to leave it in there would be somebody who's already in the 39.6% bracket, because it would bother you to know that if you distributed that income to yourself, you could have paid 15 or 25%. And now, changes for business.
Hello. So, part of the new tax law, obviously everybody sees in the news, a big piece of it was just a lot of changes for small businesses. Up on the screen, these are the ones that we're going to focus on. These are kind of the main ones that will probably affect most of the people in this audience tonight. So, first one's going to be the qualified business income deduction. That's one of the bigger ones we've heard about in the news. So we're going to start with that one. Closer. All right. Then we'll go over some corporate changes. Dividends received deduction change, corporate items eliminated, AMT credits. There's changes with net operating losses. There's also a limit on business interest deduction, and some new fringe benefit rules, and also some changes with the penalties and fines. So the first one, qualified business income deductions. This is a lot of the ones we've heard in the news a lot. A lot of people think we're going to get 20% deduction on qualified business income. That may apply to some of you, but there are limitations on it. So the general rule is you will get 20% deduction for qualified business income, and then that income's taxed your individual rates. So what is qualified business income? For example, if you are an S corporation owner and you have pass-through income on your K-1, let's say $15,000, that would be qualified business income. If you're a Schedule C filer, the net income on the Schedule C, that would also be qualified business income. Income from partnerships, rental activities, that would all be qualified business income. The point of the deduction was, and I'll mention a little bit later, is corporations got a flat tax rate of 21%. So to try to not so much mimic the actual rate, but try to also give a deduction for the pass-through owners, they came up with this 20% deduction. There is no difference in the deduction for a passive investor, so that could be rental or a limited partner in a partnership, or a non-passive owner. The limitations are another thing that a lot of people talked about was the difference between service and non-service. A lot of people thought lawyers, doctors, CPAs, financial advisors, that they were out. They weren't going to be able to participate in that. That's not true. If you're basically under $315,000 of adjusted gross income, if you're married filing joint, you get the deduction whether you're service or non-service. and there are no limitations on either. And then it's 157,500 for single. Is where that starts. So there's no, so if you're a doctor and you fall below that on your return, then you will get the benefit of the deduction. Once you go beyond that threshold of 315, there is a limitation calculation that I didn't include in the slide because it is somewhat complicated, but for what you need to know is if you're approaching that level or getting over it, there is a calculation that needs to be done. And it is different between service and non-service. One type follows one way, and the other does a different type of calculation. For the service businesses, though, once you reach taxable income of $450,000, you will be completely phased out. The non-service will still have some type of limited deduction, though. And then these deductions are applied at the individual level. They're calculated on your individual tax returns, not on the corporate or the entity returns. Engineering and architect businesses are excluded from the list of service businesses subject to their limitation. Basically what the government has said, though, on service versus non is they list off, doctors, physicians, and CPAs, lawyers, and then they end the sentence with anybody that uses their personal skills as a business. So that kind of blankets a lot of things. But they specifically reference engineering and architect not to be a part of that. Trusts and estates are eligible for the deduction as well. So moving on, so some changes to the C corporations. Before they were on a graduated system, just like we do with our individual tax returns, they are now a flat rate of 21%. How this would apply to a lot of small C corps, probably not too much, because a lot of time we basically, when planning, we pay everything out in wages. I know for a lot of clients I work with, we would usually only leave enough income in to pay at 15% anyway. So actually, some of the clients we do leave income in to build equity, they'll actually be paying more tax. Corporate dividends received deduction, at least 20%. It's reduced from 80 to 65 if they own at least 20% in the company they're receiving the dividend from. Under 20%, the deduction is reduced from 70 to 50. Again, I don't know if that actually applies to a lot of people in here, but that has changed. Corporate AMT is repealed. They no longer will have that. And any AMT credits, they're refundable over 4 years starting in 2018. Corporate net operating losses. The 2-year carryback for non-farming losses repealed, and the NOLs can be carried forward indefinitely, but after 2017 they can only reduce taxable income by 80%. So in the past, we had the option to carry back 2 years and then carry forward 20. And we could use it to offset 100%. So if you had an NOL of $100,000 and taxable income of 100, we could use the whole thing to zero it out. But now there's going to be limitations on that as well. There's going to be a limit on business interest deduction. So I don't know how, maybe there's some of you that it applies to, but for every business, regardless of its form, taxpayers with a 3-year average of annual gross receipts greater than 25 million, there is a limitation on how much interest you can deduct. So, that's geared towards larger corporations than small businesses. New fringe benefit rule. There is no longer a deduction for business-related entertainment. So what that means is you take your clients to the Penguins game. Tickets are not deductible. Before they were 50% deductible. Take them, so the only thing that remains deductible is meals. So you can still take your clients out to dinner, but if you go to the Pens game afterwards, only the dinner is deductible. So what we're going to start recommending to our clients is they start tracking those expenses separately on their in their financials, just to make it easier to break out, because that will be something we will be asking as we do the tax returns for 2018 and planning. We'll have to know what the difference is between the two. In the past, we just recorded under one line item of meals and entertainment, but now we're going to need to know, need to break that out. So some of you that might affect a lot. I have some business clients that don't have any meals and entertainment, and I have some that have a lot. So something to keep in mind as the year goes on. Also, the employer-provided parking is no longer a deduction, but the exclusion from income to employees is allowed. Penalties and fines, they were never deductible, but for amounts paid incurred after December 22nd, 2017, no deduction is allowed for any settlements, payouts, or attorney's fees related to sexual harassment or sexual abuse. Cash method of accounting. For tax years beginning after 2017, the cash method of accounting may be used for taxpayers that satisfy $25 million gross receipts test, regardless of whether the production or sale of merchandise is income producing factor. That's kind of a big change. So a lot of companies, before it was $10 million, you would have to, if you had $10 million in gross receipts over a 3-year period, you'd have to switch to accrual basis of accounting. So those of you that have revenues that high, and I had a few clients that were approaching that, they're happy that they don't have to deal with accrual accounting now. And then also, if you have to account for inventories, that number was even, I think it was lower. I think it was around 5 million. They had to account for inventories on the accrual method, but now you won't have to do that either. Again, I would just mention the inventory thing. So for tax years beginning after 17, 25 million or more, under the 25 million gross receipts test, you're not required to account for inventories, but rather may use an accounting method for inventories that either treats inventories as non-incidental materials or supplies, or you conform to the way you prepare your financial statements. So you still can, report inventories under the accrual method, but you're not required by the IRS. Also, uniform capitalization adjustment for tax years beginning after December 31st, 2017. Again, if you're under the $25 million gross receipts test, you're exempt from that application of the 263A rules. Domestic production activities deductions repealed. That was a deduction for manufacturers, home builders building. They were able to take a 9% deduction in addition to the regular expenses. That is no longer available. And then they also repealed the partnership technical termination rules. Again, this is just a summary of some of the things I've gone over. Again, being under the 25 million, you don't need to utilize the accrual method of accounting for inventories, the uniform capitalization adjustment rules, or accounting for long-term contracts. Section 179 expense. After 2017, the max amount a taxpayer may expense is increased to $1 million, and the phase-out threshold is increased to $2.5 million. And these have been, and the new law does have them adjust for inflation going forward after 2018. So the current rule is in 2017 it was $500,000 and $2 million. Once you go over $2 million, then you start getting phased out. So this looks like it's going to be, I think it's permanent, right? That's not expiring. So before it was constantly expiring, and then they were just renewing it. So now it's permanent, and they're going to index it. Qualified real property Code Section 179 is expanded to include the following improvements to non-residential real property. This has to do with rentals, roofs, heating and ventilation, air conditioning, fire protection, alarm and security systems. Before you couldn't utilize 179 on these types of expenses, but now we'll be able to, and that's on non-residential real property. Bonus depreciation, they're gonna phase this down. So for pieces of equipment, new purchases placed in service before January 1, 2023, you could do, much like 179, you can utilize bonus depreciation, which is only for new purchases. Section 179 is new or used, but you can take 100% deduction for that, and then it phases downward through 2027. Oh, is that the end? I guess that's the end.